Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to The Bigger Picture. Me, Ryan Huang. U.S. President Donald Trump has switched up the game again just hours after the dust began to settle when higher tariffs came into effect. He has hiked tariffs on Chinese imported goods to 125% effective immediately. He also announced a 90-day pause on tariffs above 10% for most countries except China, Canada, and Mexico. What does this mean for investors looking at China? Let's check in now with Kian Soon. He is the CEO for Astral Asset Management. Kian Soon, how are you doing these days with the market turmoil?
Good morning, Ryan. Never a dull moment.
All right. Not a dull moment indeed. We are seeing quite a huge reversal right now. So good news for most countries and markets, not so much for China. How do you see markets pricing in the new developments? Is the worst over, or is the can kicked down the road?
I guess we have experienced a remarkable period of financial volatility over the last 2 weeks since the tariff plans was announced. And as we've seen in the most recent reversal last evening, most markets would have recovered quite strongly. We're seeing that in Asia markets today. And we could expect more volatility as different nations step in line to negotiate with America on the tariffs.
Yeah, so we are seeing quite a bit of so-called negotiations between the US and Chinese side. So that tit for tat going on. Now, end of the day, 125% tariffs on China. Are we now seeing the US leaning into a trade war? Is that where this is going into, you see?
I reckon the United States would like to have a negotiation with China, but unfortunately they have met with reciprocal tariffs hikes from the Chinese side, as the Chinese side have not been eager to negotiate, and they are very well prepared this round since the 2018 trade war, and this round the Chinese have been less inclined to negotiate or even bend over, and they have come back with reciprocal tariffs. But as we know, any numbers above 100% tariff basically a no-go for any kind of negotiations.
Yeah. So based on the signals you're getting from the Chinese side, the reports you're getting, the data you're seeing, how do you see China responding? What's in the toolkit?
China has a couple of measures that they could do. Definitely, both sides have upped the tariff rates to more than 100%, and any numbers beyond is just to show that who has the bigger firepower. I guess the Chinese also could potentially sell off more treasuries. They hold they are the second largest holder of U.S. treasuries, and I guess they have been selling down the last couple of days, which will drive out the U.S. treasuries rates and destabilize the American fixed income market. And thirdly, which is always in the toolkit, is to look into the depreciation of the renminbi, and that would definitely again mellow down the effects of tariffs.
Yeah, do you see them putting into effect more perhaps non-tariff measures, especially with a lot of U.S. companies with Chinese market exposure? We have the earnings season coming through as well. Is that a likely avenue for them? There's
always likely measures possible, but I guess a more effective way that they have been already announced. Control of raw materials as well as rare earth elements, which is a core component for the U.S. manufacturing in a lot of industries.
All right. So in the face of all the market turmoil and the back and forth, you're quite a big investor in the Asian markets, particularly China. How are you approaching this space right now?
We are approaching the Chinese markets with prudent optimism. If you look at Hang Seng until closing last evening, it's actually a positive year to date, while a lot of the markets are actually in the negative territories. And we thought that the sharp correction that happened in Monday for Hang Seng, followed by 2 days of recovery, even after the series of tech responses have shown that the Chinese markets have been more resilient this time round. And I reckon, given the escalation of both countries on these tariff hikes, the Chinese government is likely to announce a series of measures and policies that will boost the economy in the coming weeks.
All right. And you also mentioned to me that your fund did pretty well in the first quarter. Have you started to reposition? And what have you been doing since then? Taking profits or just rotating elsewhere?
Well, we have continued to invest actively as we are active fund, and we focus on companies with zero trade or export elements. Hence, we allocate predominantly to domestic consumption and healthcare companies in China. As the Asian markets went into a sharp correction recently, we have seen and we have witnessed this in 2018 trade crisis and the 2020 COVID. It also offers fund managers a good opportunity to buy into good companies at relatively very low valuation. We are also not leveraged, hence we have a long-term investment horizon.
Oh yeah, mentioned domestic consumption and healthcare companies. So are you expecting, a revival of the Chinese economy? Are you expecting more stimulus measures as well?
Definitely. If we look at the whole component of the Chinese economy, around 3% is exposed to the American exports. And, if trade globally is affected as a result of tariff hikes, they definitely have to look into the stimulation of their own consumption in order to boost up the economic growth.
Okay, and also worth noting, you've been watching capital outflows from the US in March. Where have these flows been going to in the past few weeks? Are you still seeing that momentum continue? And where is the smart money going in that sense?
I think the initial outflows is a reaction of the blanket-wide tariff hikes that has been announced. And it's a sharp reaction from the announcement that was made. And we might see some reversal given the U-turn that was announced last evening. There's also, a change of asset allocations or equities to the bond market, and that creates a lot of volatility across different asset classes. The market is actually watching very closely the fixed income market in the United States, as it has huge implications for many financial institutions. And the U.S. Treasury's yield for 10 years and 30 years have increased and spiked rather sharply recently until last evening. So markets will continue to look out for any signs of volatility as well as capital flow. Yeah,
with all the volatility, would you say it's actually a good approach to stay invested in the markets because it's so tough to catch a bottom?
As we always prescribe that it's always hard to time the market. Those guys who have shorted the markets after the massive outflow in the recent weeks have lost money yesterday evening because they never expected announcements to be made so swiftly. It's always better as investors to stay invested in a volatile situation, as it's literally impossible to time the market given that is massively triggered by the volatility is massively triggered by announcements from one single person.
Yeah, it's really headline sensitive these days. You never know when or how much you could swing. We've been in conversation with Kian Soon. He's the CEO of Astral Asset Management, helping us navigate the market turmoil. Kian Soon, thanks for your time this morning.
Many thanks.
All right, catch up with you again soon. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.